Arvind Chari, Chief Investment Strategist, Q India, in our studios, based out of Singapore, but right now in India, in Mumbai, after the Delhi trip.
Yeah.
Arvind, great to have you at the Profit Studios.
Very good to see you.
Pleasure as always. How was the Delhi trip, apart from the pollution? How were the conversations vis-a-vis India?
Yeah, I did fall sick, so it wasn't a good trip from a health perspective, but it was a fantastic trip from a macro perspective. I live in London. I don't live in Singapore.
Okay.
So I've kind of lost touch with what the Delhi policy making viewpoints and policy guidelines is. And I came back. I've been reasonably constructive on the Indian macro recovery, and I'll give you reasons for that. But I also got, like, from the policy think tank and from the policy perspective, I came out with two things. One is we have to very closely watch that deregulation commission. There are two commissions formed by the government. One was on deregulation and one was on, like, the Gauba committee and the Somnathan committee. And they are coming out with suggestions. Some of them are already being implemented. For example, the quality control order, which was removed, which should have never been put in the first place. So, you can debate why it came in and why it's gone down. What was it, only rent seeking, or was it only, favoring a few sectors, industries? But one of the outcomes of one of these committees is to, take down QCOs in some very key sectors. So I think the government is thinking a lot on those parts. I think the DOGE aspect, which started early this year in the US, that deregulation aspect looks like it is feeding through. So that is something to watch out. The labor code was supposedly mentioned that will get implemented and actually already got notified. So you're seeing some, I think it's a reflection that they've realized that the nominal growth is not as high, and they need to do what we've always called second generation, third generation reforms to be able to get our long-term real GDP growth from 6.5 to, say, 6.5, 7.5. There is realization. Whether they are doing enough and all, we'll come to know in terms of how things pan out. But yeah, in general, although the sense is still 6.5, 7% GDP growth, but in the background, you can see a lot of these.
What do you make of the labor codes and the impact of the labor codes? I mean, seen as negative yesterday for some companies which employ gig workers, etc. Very positive for those in the formalization of employment business. But how do you see it as a impact over time?
I think it is going more on the formalization part, where they want to formalize a large part of the economy. But I would see, like, even for smaller enterprises to have social security and all those aspects, I think it's going to be onerous. Looks like they've reduced the number of licenses and they've reduced the number of filings that an entity need to do. But still, if you're a small enterprise and the cutoff is doesn't seem very high, like even for a 100 people employee base, you will need to do all those, follow all those registrations and guidelines. So it's a mix. The large companies will be able to manage it in terms of, because they will have consultants and people helping it. For the smaller enterprise, it looks like it's going to be a bit more onerous than what the general perception of labor code is, that hire and fire. That's the connotation that we come about with. It's not that. It is a fairly
but it's
significant.
a better version than what existed.
Absolutely, because of the codes being number 4, and I think if you see the number of guidelines and the number of licenses drastically, the number of forms that you need to fill, it is much lower. So I think it's a mixed thing. But it's going through the function that you need to formalize a larger part of the economy than what it is currently. So, GST was one such formalization effort, right? Digitalization is another such formalization, and maybe the labor code is.
So Arvind, with this formalization, what is that impact that you're seeing when it comes to the markets? Because that's what people want to hear.
Yeah.
You have been of the opinion that India is an underallocated market as well.
Yeah.
When do you see those FIs coming back? I mean, they have been consistent sellers right now.
Yeah, so if you see, since last year, right, September 2024, we must have seen about $20-25 billion of FI sales. Now you have to see it in different perspective. One is, as percentage of market value of what they actually own in India, about $800 billion, it's not that much. 25 billion out of $800 billion of market cap is not much. But the way you should see it is, I think about 80% of the flows that India gets in the portfolios as foreign portfolio investors comes from what we call global allocations or global emerging market allocations or Asia allocations. These are not dedicated India allocations. So for them, it has always been a relative trade, right? India is relative to some other country. So if you look at the previous decade, you would have seen that India was always an overweight in a active global emerging market portfolio as compared to its normal weight. But as India's weight has gone up, India's weight has gone up from like 8% of the MSCI EM index 15 years back to now almost 20%. It went actually about 23, 24%, and it's come down. So the overweight also has reduced from that perspective. And I think now if I see some strategy reports, it's looked like India is kind of underweight. Like for the first time, you're seeing a underweight in global emerging market portfolio. So that is what is leading to the outflows that we are seeing. You can argue that India's nominal growth and nominal earnings have actually come down a lot, and the valuation, especially last year, September to December 2024, the valuations were significantly higher than what they were getting in some other countries. And then China became investable. AI was a big theme, and you're seeing some of those outflows. So that is the context, and we can talk about it in detail as well.
Yeah, let's talk about it in detail, but just want to mark the pre-open session as it opens right now, and just bring up some of those rates, by the way, and just see what's happening there. So Nifty, well, this won't last, of course, but keep an eye out for IT, because I think Nasdaq and Nikkei and the moves that they have done, and just keep the IT space in focus. Remember, Nifty IT was the one that did reasonably okay yesterday, and then keep an eye out for the defense and the real estate names and the kind of pummeling that they took, whether that continues or does that change. I think that's the other key thing to keep in mind. By the way, I know Sunny and Kunal, if Kunal is with us, just wanted to make one quick check with him before we thank him. Okay, I think we just get that feedback, so we'll get that going as well. Arvind, are you of the belief that flows come back in 2026? There seems to be a thought that from a bottom-up market that India has been, because of a confluence of factors, it could turn top-down, and flows could come in as well with moves happening, etc. And what are the necessary conditions for this? Is the trade deal a necessary condition for flows to come back, or can flows come back because of the relative valuations becoming okay too?
I think it will be more relative valuation. So if you look at the thing that we've been hearing, so India was not AI till September 2025, because India does not have foundational LLMs, and we don't have high semiconductor chips, and we don't have a basic AI, like a large AI behemoth that we have. So we've been underrated, and money has actually gone, and logically so, into China and Taiwan and Korea, where the AI plays, at least the first AI plays are happening, right? And then now that the AI is a boom, or it's a bubble right now, you already seen that India may be what is called a reverse AI trade, because India does not have any AI play, India should be beneficial. So I think the global markets will go through this investing swings, and I've written about this, and I've said this, that India was BRIC in 2005, right? India was Brazil, Russia, India, China. It was India's birthright to grow, and then a lot of capital got deployed in India based on that 8-9% growth expectation. The small cap rally fizzled out into 2008 after Lehman, and the infra and the real estate plays got fizzled out after 2011-12. People lost a lot of capital. Then India became Fragile 5 in 2013, right?
So now?
So then India was China +1 till recently, because, and you saw that a lot of venture capital and private equity money that India received was basically China +1. China was uninvestable after COVID, and that money came to India. So I think you will see these themes, that people like to play themes, but the Indian story remains, although it's a top-down aspect, but it remains the bottom-up story of, can companies be able to grow in double-digit nominal GDP, and can they compound their revenues and earnings in double-digit nominal GDP? And all you need to do in India is to find companies which have good return ratios over cycles, and they're available at a decent valuation for you to buy. I think those aspects are coming into play. I think the relative valuation is better than what it was a year back, for sure. The growth aspect is still a aspect of, people will think about it. But I would think, as I said, and I can talk in later, that there is an upswing that we can see. There's a cyclical recovery.
Okay. Now, Arvind, you don't get into the minutiae, but I would love to understand, if you believe that money eventually will come back to India, right? Would it be safe to assume that therefore the large caps and therefore the ITs and the banks of the world, which is the first port of call for FIs per se, and maybe autos, should be the pockets that even retail should keep as the fishing pond?
I think it will be a function of valuations and the weights of the sectors in the large indices. So if you track the large cap indices and they wait for the, or they do the MSCI EM benchmark, these sectors, as you said, IT services, financials, and auto, they tend to have large weights. And if I look at our portfolio, the Q India Value Equity Strategy or the Quantum Value Fund in the mutual fund, we are right now overweight financials, all aspects, banks, private banks, financials, life insurance, general insurance, asset management. So we're playing the entire lending and the saving side. We are gone scaled back into IT services purely from the view that we think what happened with Y2K and digitalization and cloud, where these IT services companies were the ones who deployed at scale at enterprises. I think AI should something be very similar in the sense that these IT services companies will deploy AI at scale at enterprise. Unless there is an enterprise AI, the large guys, OpenAI becomes a large enterprise AI function. But these companies have known to do global delivery, and they will be able to deploy at scale. So that's our call. It might be a problem from the employment perspective because as they use AI more and more, the entry level jobs, which has been the best job that anyone could find in the last 20-25 years in India, that is a big risk. From that perspective, I think IT is a worry, but from a company perspective, productivity, I think that'll happen. And the third, as you said, is auto, which is again another sector that we are reasonably overweight from a consumer discretionary, consumer durables perspective. So you should expect that. And if you look at relative valuations, the large cap is about 22 times, just above long-term average, but the mid and small cap are still significantly above its long-term average. And we don't see growth being that high. It's not that these companies are compounding at 20, 25, 30% to justify the valuation. The nominal growth and the 2-3% of our nominal growth, about 13-14% is what many people are even struggling to achieve. So from a relative valuation and the indices construct, you would expect a large flow to come to the large cap or the larger place.
Okay, so would you say that all your new age sectors then somewhere would be an avoid, because the narrative over there is high growth, high multiples, and that's what you're looking at. So will those sectors be a complete avoid? What should that strategy or narrative look like?
I don't think it will be complete avoid. If you see in the last 10 years, you have seen dispersion. Like even you've seen that in mutual fund allocation where 10 years back, 90% of the allocation would have been in the top 100 stocks. It's not there anymore. You can see a lot more dispersion into mid and small cap names. And we have seen something similar with the FPIs as well. So some of them who are bottom up and stock pickers, and if they find that the Indian new age sectors, you name it, IT services, even defense would be a new age sector in the sense that we have not had defense manufacturing in India. We have not had electronic manufacturing in India. So these are all essentially new ideas from an Indian perspective. Again, for us, as a value manager, it is a function between growth and the relative valuations. But for some, it could just be compounded growth over a long period of time. And you've seen capital go into that. So I won't say it'll completely rule out. But the way a large global EM indices or passive or even active, which are hugging the index, they will tend to allocate more to the larger names initially when it comes, purely because of valuation comfort as well.
I'm wondering how you're looking at the hectic activity in the primary markets in India. Yeah. And a lot of companies coming in which are puzzling for traditional investors on how to look at them. And where cash burn is okay, it's part of the picture. TAM is the biggest question. And I wonder how you look at some of these companies or at the IPO frenzy that we're seeing.
Especially in IPOs, we've actually never invested in IPOs because
never.
Quantum has never invested in a single IPO. Maybe Infosys back then, when in the early 90s, that would have been one.
But that was Pichla Janam.
Yeah. Because our simple belief is that the investment bankers who get the mandate is the one who offers the best valuation to the company, and that might not be in the best interest of the investor, right? So we cover some of the IPOs are large, so we know that we will be able to deploy capital at scale with the liquidity filter. So we do cover them. some of the new age, we kind of use a mix of different ways to value those companies. To understanding business is fine, but the question is valuation. So we might use a mix of a long-term DCF with a long-term, terminal growth rate projection, and then combine it with some other metric which works for the industry, right? So for some metrics, PE would be the ratio. Some metrics you might just have to look at EBITDA and try to see EV EBITDA. So we'll try and combine a different way of valuing those companies, because we don't have a historical precedent in terms of how they do. So it's a mix and match. In most of the other segments where, say, insurance or autos, where you have seen new companies, we know the historical trend.
Tested. That's
we know the history. We know the long-term median fair valuations of this company, this sector, globally and domestic, and then we can do a benchmark valuation. Some companies can be really challenging, like the EMS space, given the fact that I don't think they're doing much value addition, but their revenue is compounding in a very significant manner.
And great return ratio.
And great return ratio, because the asset turns.
Asset turn is great.
Yeah. So in that, you'll have to, from a value manager perspective, it kind of gets challenging for us in terms of just looking at the revenue multiple, and we cover those companies as well.
So Arvind, sorry, you will then therefore not participate in any of the tech-enabled platform plays in India. All of them are new companies, right?
No,
IPOing
we'll participate.
After they list.
Yeah, after that. Not
maybe
in
if
the
they go
IPO.
at a higher valuation, you'll
Have
be
you
able to buy.
participated in any of the big
Exactly.
stories, Eternal, Swiggy, or any of the platform companies,
Paytm, what have
FinTech, Paytm?
No, we've covered them very actively, but from a
Just
valuation,
stayed away, huh?
I mean, for us, it's a discipline of valuation, right? We look at companies over a 2-year forward valuation. We focus for 5 years and we look at 2-year valuation, and we try to see whether on a discounted basis, are we able to buy at a discount to intrinsic value. These companies, they came very close to our buy prices maybe 1.5, 2 years back. We're kind of missed at that level.
Okay.
But that's fine. I mean, there are enough opportunities to play in India. But the way we do it is we do cover all of them. Like, we have active coverage. When you say active, we'll actually meet them very regularly. We have an updated model. And we know the buy and sell price that works for us from a
So they're on your
valuation
radar,
perspective.
but you haven't
Absolutely.
dipped your toe yet.
Yeah, correct.
Okay, interesting. Thank you so much, Arvind Chari, for joining us in the studios and speaking with us. It's an absolute pleasure to have you here, and hope to see you back from your next trip from London.
Thank you so much.